Have you ever dreamed of earning money while you sleep? What if there was a way to make your money work for you, rather than the other way around? A lot of people have the wrong ideas about trading in the stock market. Investing is like trade or gambling, or it's a way to get rich quick, to name a few ideas. These not only give people false information, but they also keep them from the best way to make money. For the most part, investing is a tried and true way to get rich over time. Records from many years ago show this to be true. As an example, if you had put $8,000 into the S&P 500 index in 1980, that money would be worth about $783,086.76 today. Let's break it down. You can make money in the stock market in two ways: through capital gains and earnings. Here are some easy ways to make money. Sell stock shares for more than you bought them for. Let's say you buy Apple stock at $50 per share and then sell it when it goes up to $120 per share. You keep the difference. Dividends are the second way to make money. A dividend is money that a company gives to its owners. Dividends are a way for a company to thank its shareholders for their investment by giving them a part of the company's profits. The dividends are paid out often, usually once a year or every 3 months. But some stocks pay a yield every month, so you buy stocks that pay dividends and get paid often. What is investment in dividends? As I already said, people buy stocks that pay dividends to make more money, make passive income, or grow their gains over time. When people buy in stocks that pay dividends, they can get cash from their stocks with almost no extra work or cost. Also, income stocks protect you from changes in the market. This is because stocks that pay dividends will always give you a return, even when the market is going up or down. It's good to have a steady income that can help you handle losing money on assets, especially during a bear market. On the other hand, keep in mind that not all stocks do. The company might not pay its owners, but instead put the money it makes back into research and development, growth, or buying other businesses. That can make the price go up, which is good for owners in the long run. The board of directors chose whether to pay dividends or not. Amazon has never given a dividend, and they might not do so either. Still, the stock has given a gain of 193,521.39%. Just because it doesn't pay an income doesn't mean it's a bad investment. When you look at income stocks, look for these things. So now you know what it means to invest in dividend stocks. Today, we're going to talk about how to find the best income stocks for your money. To choose stocks that pay profits, here are some things you should think about. Yield on dividends. When buyers look at possible dividend stocks, the first thing they look at is the dividend yield. This is the dividend that is paid once a year, shown as a portion of the stock price. In this case, the dividend yield is 5% if the share price is $100 and the payout is $5 per share. You get more dividends if the dividend return is high. There is a catch though. Not all the time, high dividend rates are a good thing. Because as you can see, the profit that was paid the previous year is taken into account when getting the dividend yield. In other words, if the price of the stock goes down, the dividend yield will go up. People who are new to investing might think this is a great stock that pays dividends, but it's not. In order to get a better picture of the company, investors should look at more data. Rate of return, result as a percentage. In this case, Apple's payout ratio is 24% if it gives away 24% of its net income as profits. You can also split the dividend per share by the earnings per share, EPS. The plan is to find companies that have a high return but only give away a reasonable amount of their income, like Apple, which only gives away 24% of its net income. If you want to find the best ratio, buy in companies that pay out no more than 55% of their net income. This makes sure that they can keep paying dividends without having to cut back on investments in the business. Pick stocks with dividends. You can do this in a few different ways. A stock screener is the best place to start. There are different stock screeners built into most online brokers that are based on different trading strategies. There is where you can find the reward screener. After making a list of possible stocks for your dividend buying plan, it's time to look into each one in more detail. Check out the payment rate. It's time to use what you've learned about dividend rates and payout ratios. I already told you why only looking at dividend yield can lead you to invest in bad deals that will lose you money. When you look at stocks, you should ideally look at the return ratio. It's important to remember that you want a good return ratio that you can keep up. This means that the payout split shouldn't be too high or too low. It does depend on the business and the field. If you're a big company in an industry where you don't have to spend a lot of money on R&D or capital projects, it makes sense to give large portions of your profits to your owners. This can be seen in Coca-Cola. However, it doesn't make sense for a biotech business to give away a big chunk of its profits, because in order to succeed, it needs to spend a lot of money on R&D, capital expenditures, and other things, growth in dividends and past payments. You should also think about how well the business has paid dividends in the past. Have they been paying dividends on time every time? What's more important is whether they have been regularly raising their dividend payments. Because some businesses only give dividends when they have a good year. Companies will sometimes pay out a bonus all at once. On the other hand, companies that are growing might sometimes cut payouts to make room for more growth. That's why it's important to see how well the business has given out dividends in the past. Success in the past doesn't always mean success in the future, but it does give you an idea of where the company is going. If a business has been regularly paying dividends and also been increasing payouts, that business is likely to be healthy and have good earnings growth. It could be a good dividend stock to add to your portfolio. This can be seen in AT&T. Not only has it always given dividends, but since 1987, payouts have been going up. AT&T gives 7.15% right now. In the end, pay attention to the payout percentage along with how much the dividends have grown in the past. We want growth and consistency. It should let you know how healthy the company is and how likely it is that it will keep paying dividends and even raise them. This will help you. One popular way to make your money grow is to invest in dividend growth stocks. But we haven't even talked about the most important parts yet. Check out our guide to dividend growth investing to learn more about how capital gains and dividend income can help your money grow very quickly. You will get a head start on your dividend savings plan and a lot more. If you found this video useful and want more tips on building passive income, don't forget to subscribe and hit the notification bell so you never miss out on our latest content. Let's start growing your wealth effortlessly.